Good afternoon, everyone. We'll just wait for a few more seconds for everyone to come in for today's informative, interactive webinar that we have set for you for today. Some general housekeeping items. This is a recorded webinar, so in case if you have to step out, answer a phone call, don't worry. All participants will be receiving today's presentation and also the recording of the webinar. So definitely strongly encourage you to like and subscribe our YouTube channel, as we have a plethora of previously recorded webinars to enhance the conversation with our business consultants. My name is Jesus Padilla. I am the Assistant Director here at the Florida SBDC at FIU, along with my colleague Jose Monte. He is one of our Access to Capital consultants, and he'll briefly introduce himself, his expertise, and how he'll be able to assist you with your financial needs. Jose?
Good afternoon, everyone. My name is Jose Monte. I'm an ex-commercial banker here in South Florida for 30 years. I ran everything from commercial real estate to corporate lending, small business banking. So I know all the ins and outs of the process to apply for a loan, to seek capital, which lenders to approach, others maybe not to approach. And there's traditional lenders, non-traditional lenders. So there's a host of sources out there for money, and it's about tapping the right one at the right time, and having the correct answers that their lenders are looking for.
Thank you, Jose. And then if there's any particular questions throughout today's webinar, certainly encourage you to put them in the Q&A so that we'll be more than happy to answer those questions for you. Also, this is a good opportunity for you to network, introduce yourself, what type of business you have, what type of industry, so that we'll be able to provide some additional examples throughout today's webinar. So we'll go over who we are, what we do as a small introduction. We're the Florida SBDC at FIU under the FIU College of Business. As we have a team of specialized consultants to assist you at no cost. As over here, we have the picture as we were awarded the National SBDC of the Year in 2023. We work with businesses that are physically located here in Miami-Dade and Monroe County. If your business is located outside of these counties, don't worry, shoot me an email and I'll be more than happy to connect you with your local SBDC. And then in the chat, my email address will be presented, so that I'll be more than happy to connect you with my colleagues. Since 2014, we have worked with over 8,000 small businesses. It has resulted over 119,000 hours of consulting. As a result, close to $500 million in access to capital has been accessed through our great team in the realm of access to capital. What is BizCap, which is the Business Growth and Acceleration Program, is an initiative that we have launched since 2016. It provides the hyper-local consulting, training, and outreach to small businesses in targeted communities in commercial corridors. It provides an additional tool for the toolkit for businesses who are looking to start up and also to grow as well. Some of the outcomes from the partnerships that we have done with multiple communities here in the county, we've gone door to door, met with close to 325 businesses to understand the pain points and providing them the resources for them to be successful. In addition, close to 300 small businesses have attended the community trainings and received consulting as well. Here are some additional previous projects that we have done. On the top left-hand corner, we were part of the Miami-Dade Downtown Development Authority during the Flagler Corridor as we were canvassing, followed by a previous project with the City of North Miami Beach in collaboration with the CRA. This year, the BizCap project is funded through a grant from the U.S. Small Business Administration that focuses on Congressional District 27. The Florida's 27th Congressional District, it covers the city of Miami, Key Biscayne, Coral Gables, and runs through Kendall down to Cutler Bay. The overall objectives that we would like to focus on these core activities is the trainings, the outreach, the door-to-door canvassing, the one-on-one business consulting. And lastly, the data mapping and surveys of small businesses located in District 27. The goal is to work with 1,000 businesses, either providing consulting or trainings and workshops. So I want to thank you all for attending today's webinar. Once again, my name is Jesus Padilla, along with my colleague Jose Monte, as we'll be discussing what your lenders need you to know. This is a good opportunity so you could fully understand who is part of your team. If it's a CPA, an accountant, a good relationship with a banker, your insurance agents, your vendors, your financial advisor. These key players in your team know your business inside and out, so that it provides a good collaborative insight as a good strategic approach for the next phase or the next level of growing your business. Jose, when you're working with the clients, what are some key questions or some additional collaborations with these key players in the team make those strategic key decision-making skills?
Yeah, I mean, obviously, we're referring to the small business operation. Typically, it's important that you have a good relationship, obviously, with your CPA, that you have an accountant that's doing your books. If you're a very small operation, you may not have an accountant. You may have QuickBooks or some accounting software that you may have. But it's important that you have, whoever's doing your taxes is also familiar with the business, the operation, the cash flow, and any questions that a banker may ask. Attorneys, it depends on the structure and the size of the business, how relative involved they may or may not be. Now, the banker. I think it is extremely important that every business, small business, large, that you have a relationship with your bank. I know a lot of times you don't have any loans yet, so all you have is operating accounts on pretty much deposits, online banking, bill pay, which you may have with your particular financial institution. But it's important that you get to know who is the officer assigned to your account. Every account that's opened at a bank corresponds to some bank officer. It's important that you know him because at some point in time, as the business grows, you should know that banker to start a conversation regarding, how can you grow? How can the business grow with the bank? How can you tap maybe an equipment loan? How can you get a small business loan, a working capital loan? They offer many, many different loans, also SBA loans. The SBA loans are all handled through the banking system. So if you want an SBA loan, for example, for working capital or to buy equipment or to buy a facility, a piece of property, SBA offers some attractive products, but you would go through your banker. You would approach your bank and ask them for who's your SBA designated loan officer and talk to him. It's important to have a good list of who your vendors are, because your bankers want to know, depending on what your product, if you're a service product, your restaurant, if you're selling shoes, you want to know who your vendors, where you're getting your materials from. Is that at risk? If it's coming overseas, who are you selling to? Are you selling to only you're selling your goods only to one particular retailer or wholesaler? That's risky. You're selling to 10 or 15, so they want to know exactly. Bankers like to mitigate risk, so they like to know that you have a good array with your vendors. Insurance, it depends. Insurance, if you're talking to property, obviously you have property insurance, and business insurance and what have you. If it's a small operation, still lenders like to know. You may not have it, but by the time you talk about a loan, most banks will require for you to get some sort of business insurance, and it could be business interruption insurance, it could be asset insurance, just to make sure that should something happen unforeseen, that the bank obviously has a comfort level that you'll have the ability or the resources to continue paying the loan. Financial advisor, that really depends, again, on the structure and the size of the business. On a very small business, you may not have a financial advisor. If you have excess liquidity and capital, again, I would approach your banker, because almost every bank today in America has a department of financial advisors that can help you invest your money. If you've got limited liquidity, then perhaps you're not there yet. If you have a lot of liquidity, you don't want the bulk of your funds sitting in a checking account, earning no interest. So they can offer you different products. It could be overnight products, so there's no risk. It's not that you're putting the money away and it's gone for 6 months. They have a lot of products and vehicles where you can invest overnight, so the money is earning some interest as opposed to nothing. And again, it's all about making the business work as smart as possible. So again, it's good to have, your team will depend on the size of the business. As the business grows, your team will evidently grow as well.
Thank you, Jose. And then we'll discuss more of the 5 C's of credit, because these are the key components or the good ingredients for you to become bankable. One of them is character. It describes who you are, how have you handled the previous debt obligations, and what have you done in the past that makes you qualified to start a business. It discusses more the credit score, the reputation, the experience. Jose, with character, what are some of the key components? Like it could be like missing a payment, or not having the sufficient capacity, which is one of the 5 C's. But obviously, if you miss a payment, how does that impact the reputation of the business, and also like the red flags that the respective lender will look at?
Yeah, and to put it simply, obviously missing a loan payment is not going to have any negative impact on the business or your ability to apply for a loan. Keep in mind that the way the credit system works is there's no reporting unless you've gone over 30 days, and that's typically when the credit can be reported that there's a late payment. Periodic late payments are not an issue. Lenders do like to pull that up and see what the business has performed. If you're currently banking with a current bank, and you're looking to replace that loan, maybe to a more attractive loan, to a longer term loan, to increase the loan, better rate, whatever the reason is, the new lender, obviously, and part of the discussion is, he'll know that you're currently banking with Ocean Bank. Now you're going to go bank with U.S. Century. That banker is going to, the banking community in Miami is extremely small. So they'll make a few phone calls and they'll find out how has that loan been handled. And if there's a periodic system where you're constantly paying late, a lot of overdrafts, that's going to be a huge red flag for the new lender. So that's gonna be a tough position to discuss a new financing. Credit score, the personal credit score, even though you're applying for a business loan, the way lenders look at credit score is if the ownership or management of the business has decent credit or has good credit history. It's sort of a mirror. If he runs their personal credit well, chances are the business is run in the same fashion. Especially in the small business arena, if the business has pretty good profits and money, and they pull the credit score of the individual, the owner, and it's very poor, that's a problem. Unless it can be adequately explained. Now we know there's things in life, you can get divorced. Certain things have explanation why credit could take a dip or a plunge in some cases, but it has to be easily explained to make the lender comfortable. But again, if the ownership and management has poor credit history, that's a reflection of how the business may be run or is run. So it's important that you also focus on maintaining good credit score as best you can. Reputation, obviously, and in any bank today, when you apply for a loan, typically what they do is they'll put the owner's name in a Google search, just so you understand how the process works. And they'll put probably 15 to 20 prefixes to your name. It'll be bankruptcy, it'll be arrest, it'll be all kinds of different words, and that'll pull up a search. And that's common practice now. That's all part of compliance and due diligence before any loan is approved. And so it's important that your reputation, experience, obviously, if there's something up there, don't hide it from your lender because he's going to find out. He's going to pull it up. He's going to see it. It's better to kind of head it off at the past and tell them, look, this happened 5 years ago or 2 years ago. If it happened 10 years ago, I wouldn't worry about it. But if it happened recently in the last couple of years, it will pop up in a Google search. And that's what lenders do today as common practice. So just, be ready to explain it and have a viable explanation for what took place if it can be explained. But these are all factors that a lender wants to see experienced. If you just started this business 6 months ago, that makes it tough. However, if you were working for somebody for the last 20 years in the same capacity, you decided to venture out and you started your own business, again, typical lenders like to see at least 1 year because they like to see tax returns. If you've got 6 months, it's very hard from a traditional lender standpoint to base it on anything other than internal financial statements or bank statements, which can be very helpful because they'll show the incoming deposits, the revenue, and what the month-end balance is. Now, however, there are non-traditional lenders outside of banks, a lot of community-based lenders that we deal with, that 6 months is okay. They won't ask for tax returns or financials because obviously they don't exist, but they will ask for the last 3 months bank statements. And based on that, if you've got good the business is really taking off, and you've got good deposits coming in, and those accounts are handled well, that's also a way to get a small business loan outside of the traditional banking sources. And these community lenders, they're geared solely to help small businesses. They don't do car loans. They're not doing home financing. They're here to do literally small business financing, and they've got money to lend. Their credit requirements are much more liberal than banks. You could have a credit score under 600, and these community lenders can still work with you as long as you've got incoming deposits. You've got the business. The business is operating. It can't just be, I opened it 6 months ago and I've got $500 coming in a month. That's not going to work. But if the business takes off and you've got 20, 30,000 in deposits coming in, revenue, the business is selling. Those are all important factors. And again, there's many different lenders that work in many different arenas. So it's not just traditional banks. Traditional banks are the toughest ones for loans because they're regulated and they have the most requirements. The underwriting process is more rigorous and they ask for more documentation. So the banks, you've got to have your A to Z in a row. These lenders expect to have answers and financial documentation for everything. So just something to consider.
Thank you, Jose. And the next one is the capacity. It's the ability to repay the debt. It could be the debt to income ratio, the debt service coverage, other sources of income, the rental income. Jose, like I know that we previously spoke about some of your clients that obtained a lot of capital, and now seeking additional capital, but doesn't have the capacity to repay it. So what are some alternatives or any additional assistance for clients or anyone that's present here that needs some capital but doesn't have the capacity? What are some ways to triage that front?
Yeah, I mean, obviously, if you've already taken on several loans, it's great that you got those initial loans. Remember, we had the COVID era, and there's a lot of programs out there. They're still offering loans outside the traditional lending bank environment, and it's good that you might have gotten those loans, as long as the business can support the repayment of those loans. If those loans tide you over during a certain rough period, now obviously we're no longer in that so-called rough period. You're looking for additional financing. Depending on the amounts of capital you took, there are some loans out there. There are some programs out there that are still available. Remember, these programs come and go. They're not evergreens. They don't open and they're around for 30 years. But there are certain programs that may open that it could be around. Maybe they offer 100,000 at a very super low interest rate, and they're here to help you. And those monies can be used to refinance some of the other loans, perhaps at a higher rate. So there are some programs out there, but the ability to repay. I mean, that is the first and foremost any loan discussion. You may have the best financials, the best credit score, the best product. You may be selling, the tax returns may reveal very good increasing sales. That's all fantastic. At the end of the day, there's got to be the ability to repay debt. Now, obviously, small businesses, when they're growing, the money you're making is usually poured back into the business. So sometimes, very little income is showed. So again, one, have a very good relationship with your banker, because your banker can see you, and banks they're in business to lend money, and they like businesses that are growing because they like to grow those businesses at the same time. But again, outside of that, there's a lot of programs. There's also grants. Grants now, keep in mind, depending on the amounts of capital you may need, grants is like free money. That doesn't have to be repaid, but grants come and go, and they get pretty much, so they come out and they get subscribed quickly because people are out there applying left and right, and it's free money. The requirements are usually depending on what the grantor wants to know. It could be based on a particular city, particular industry, a particular ethnic background, gender. It depends, who particular in the community they're looking to assist. Grants from $500 to small, and I would say 10,000 to 20,000 would be a large grant. And again, obviously, you can imagine the $10,000 to $20,000 grants are fewer and far between. The smaller ones, there's more of those, but again, it's there's an application process, usually online, very simple. The business, for example, let's say that it's doesn't have a great debt service coverage, the ability to repay itself, but let's say the business has other sources of income outside of the core business. Let's say the business owns some property, owns a rental, owns the building, and it's only occupying half of the building, the other half is being rented. So other sources can help, but at the end of the day, the business has to be able to exhibit the ability to repay the loan. If there's no ability to repay the loan, that's a very tough call for a traditional lender like a bank. The community lenders are different. They don't, their repayment, they're very liberal. They're not looking for excess debt service coverage to pay. They're looking, obviously, the business is growing, that it has some income, that the business accounts are reflective of the money coming in, and they have positive balances at the end of the month. When you have business accounts, make sure that you're not commingling personal transactions with the business account, because at the end of the day, maybe you're draining your account, paying off everything. Trying obviously to avoid taxes. You're paying off every expense, both personal and business. But at the end of the month, your business account shows minimal or negligible balances, and that's very tough for lenders. They want to see that that the account is handled properly. At the end of the month, there is some cash flow. There's some cash sitting in the bank. Obviously, rental income, as suggested, that's if you have anything outside the business, the personal. Again, any sources of income can all be used to repay a loan, assuming you have outside sources outside of the small business.
Thank you, Jose. And also, there's a question in the Q&A in regards to where can you find these programs or grants. My recommendation is to shoot me an email, so that we'll be able to connect you with Jose, and he'll be able to guide you and assist you with what type of grant opportunities, what programs is best suited for you. Because at the end of the day, no two businesses, no two industries are the same. So there is always a revolving door in regards of which programs are available at this present time based on what type of industry or what type of profile or makeup of the business.
Right. And on grants don't require, unlike loans, grants don't require that you have a particular level of sales, other than usually they want companies that do not sell more than $1 million. Obviously, they're looking for small businesses on the grants. So they're looking, again, to assist the small businesses. There's no requirement on how much profit. They're not asking for your tax returns typically. They ask for proof that the business is around and it's active, not just open in some biz, that it's actually active and operating. They may ask for your bank accounts to see money's coming in, money's going out, that you're an open and active business. And obviously, each grant has its own unique requirements. City of Miami, Palaca, Latino, female in the beauty business. It depends. Each grant is different. It has different requirements, but the process is usually easy to apply. It's online, so it's an easy process to apply. Nothing to lose with these grants.
And then the third C, it's capital, which is the down payments, the percentages, and the equity of the project. So this is a good opportunity for you to have a good understanding how much capital you have, or in other words, how much skin in the game you're able to provide, which it parlays with the collateral, which is one of the additional 5 Cs.
Right, and this reflects more to if you're looking for a small working capital loan. This is not what capital is referred to if you're buying equipment or machinery. Obviously, there's a down payment involved. There's a percentage, there's equity, much equity in the machinery. Are you putting up? If you're buying your warehouse to move in, if you're relocating your business. So these are factors. This is what the capital refers to when you're buying more of long-term assets for the business. That's really what it refers to.
The fourth, it is the collateral. It's the assets that the lender accepts as security of the loan. It could be the mortgage, the rents or leases, the UCC filing, car, any accounts receivables. So this is just in case if you don't have the capacity to repay the loan, you're putting something up as a security for a loan with the lender. And Jose, like while working with your clients, how much of a percentage of a collateral is ideal for the clients to put up to get capital?
Yeah, and it's going to depend. If we're talking about equipment, machinery, there are SBA loan products out there where the minimum could be as low as 10%. Now, these particular products with the SBA, obviously there's a good and bad. The down payment requirement is low, but the rates in the market right now for these SBA, call it the 7A loans, the rates right now are 12 to 13%. So these are things you have to compare. If you're buying equipment, sometimes, I would certainly discuss with the vendor. The vendor usually has financing lined up from A to Z, whether it's A credit, B credit, C credit. So, it's good to explore all the possibilities so you make the right decision. And obviously you get the best financing deal possible. That's on equipment. Also the same thing if you're buying a car, trucks. Your best financing for these are gonna be the actual vendors. Remember, these vendors want to get you in the car, they want to get you in the truck, they want to get you out. So they have probably the best financing deals outside of that. Now, if you're buying a fleet of 10 trucks, if you're buying a business, this is a larger transaction, and you're buying a small business and it owns a fleet of 10 trucks, the SBA might be your approach because they have again, the 10% down payment, the rate's a bit higher, but this could be sort of a bridge financing for you to get the deal done. I mean, this is not a long-term financing for 10 years. You get it done, the business grows, and as you have excess cash flow, you pay that loan down, or perhaps you refinance it elsewhere. But the transaction was able to be done. A typical small business, when they go to a lender, you're going to offer them accounts receivable, inventory, UCC filing, which is a shadow mortgage that's going to cover inventory, accounts receivable, business equipment. A lot of times lenders look at this as sort of unsecured because at the end of the day, should the business fail, collecting on these receivables and the inventory, it's difficult and the value is highly questionable. So again, that's why going to traditional lenders, you've got to have good ability to repay. Your bank accounts have to show good liquidity after the end of the month after paying the bills. Credit score. These are all factors that every little factor is like a puzzle, and the more pluses you have, the easier it is to have a loan discussion. And again, you can have a loan discussion with any lender or with any community-based lender, which is not a bank. But one discussion that I would tell you as a business to definitely have a discussion with the bank where you maintain your business and or personal relationship. Again, they know you. They don't want to lose your business. And also, they also have goals to put out small business loans. They're small business bankers. They have goals to get accounts and also to put small business loans. They're not doing a charity though. Loans have to work. They have to be underwritten, and there has to be the ability to pay. But I would certainly have a discussion with them, even if the answer is no. You'll get insight into why it's no, what they're looking for, and maybe in 6 months, in a year, maybe the items they need you've accomplished. And obviously, since they have your accounts, they can see your history of the business, the money coming in, the money going out, how is it handled. So that's why I highly recommend that you handle the business accounts properly. Try to maintain them separate from the personal accounts. And obviously, cash businesses, obviously, I know there's a reason why you don't deposit that cash, but obviously it's a double-edged sword. If you don't put the cash in, the account's not reflecting the true activity of the business. When you go to seek a loan, that doesn't help you much because you have limited monies going into the account. So it's a double-edged sword, and you have to decide what works best for you in your business. But again, UCC filing is typical on a small business loan. Once you get a small business loan, great, you got it. Now, when you want a second loan, if you go to a different lender, he's going to see you already have a UCC filing, and that means that whatever funds or whatever loan he approves, he's going to be in second position. So second position of a so-called unsecured type scenario. So, try to grow with the bank that you're with. As a business grows, these lenders want to grow with you. But again, assuming there's ability to repay, and you have the documentation to show the receivables and the inventory, and the business is growing, these lenders they want to grow with you, but the business has to have the ability to support it.
Thank you, Jose. And then lastly, the conditions. How do you intend to borrow the money and use it? It could be purchasing purpose of the loan, industry trends, the interest rate, term of a loan, the economic conditions. So and at the same time, it could be purchasing new equipment or buying and selling additional, warehouse. So it's other conditions that is the intended usage of the funds. Jose, with you, so like obviously with the conditions, then there's the other areas of the 504 and the 7A loan.
Yeah.
So how does that parlay with the conditions?
I mean, talking about bank loans, the purpose of the loan, I get a lot of small businesses that, for example, will tell me, let me send you my tax return and let me know how much I can borrow. And I go, yeah, I can do that on paper and let you know, based on this, you can borrow, you can repay X amount. Unfortunately, lenders do not work that way. Lenders do not want to hear, how much can I get approved for. They want to hear, look, I'm in this business, I'm in this market. This is my industry. It's not seasonal. It's this. I need X amount of money because, for example, right now I'm buying 2 containers a month, and I'm turning around and selling them, and I'm being short of inventory. If I buy 5 containers a month, I can generate more sales and more profit. That's a specific purpose of a loan, and you're representing that. Look at what I'm generating with 2 containers. If I can just duplicate that with 4 to 5 containers a month, I have more sales, more profits. The business will grow that much faster. That's what a lender wants to hear. How is the purpose of the loan tied into the business? Not just, I can repay 100,000. Give me 100,000. Lenders will not give you 100,000 solely on repayment ability. There's got to be a purpose to the loan. Because they're not going to take that money to go to Las Vegas, buy a new sports car, which obviously once you get the money, you can too. But you want the ability, obviously, if that happens, that will be a very short banking relationship. So obviously, they want to know the purpose of the loan that's tied to the business and how those loan funds will generate growth in the business, more sales, more profits. And in turn, it gives you the ability to repay the loan. They want to know, what are the industry trends? Are you in an industry that you're selling now, let's say VCRs, to use just a comparison. VCRs, obviously, it's gone from the business. So you've got to be in a business that is growing, that's in demand. So they want to know are you seasonal? Hey, I only sell, I'm selling toys only during the Christmas season. That's tough unless you are really a huge retailer. For a small business, that's tough because you make all your money in 2 or 3 months. If there's ever a bad season, you can't make it up, during the summer or the fall or spring. You gotta wait 6 to 9 months to again generate a good economy for you. Term of the loan, obviously, it all depends on the loan product. There's lines of credit. There's short-term loans, there's long-term loans. Long-term loans are typically for fixed assets. If you're buying equipment, if you're renovating your let's say your business, if you're buying a warehouse to house your business, or you're buying a national real estate location. You're buying trucks. Those are more long term. And also, what's the economic conditions that are out there? Sometimes there's a time to sit back and you know and wait. Right now, the interest rate economy and the banks it's a little high. The SBA loans are high. You have the SBA 504s, which is to buy again long-term assets, property, trucks. They're not to buy office equipment. They're to buy long-term titled equipment, trucks, vehicles. If you're a shipping container, if you're in that business, or to buy a property. These are long-term loans. They have long-term rates, and they are attractive. And again, that loan product is handled again through the traditional banking system. And they also have other loans, a 7(a) program, which is more of your working capital business loan. They do sometimes will take equipment as collateral, but these are more of business type loans, not tied to property. They may take sometimes they'll do that kind of loan and they'll tie a truck. These loans are good. They offer very low down payments if it's an acquisition type of loan. But the rates right now in the market are high. Again, 12 to 13%. But as I mentioned earlier, this could be just a bridge to get a certain growth, to help a business continue in a certain sector, in a certain condition to continue growing. And as you grow, you can refinance these loans or this debt or pay it off. So again, you've got to see, you've got to kind of weigh it out. Does it make sense to take on a 12% loan? If you're going to break even, I'd probably tell you the answer is no. But if it's gonna generate more sales, or and again, even if you break even, if it's keeping the business growing and keeping your staff employed and your name out there in the communities, hey, I'm still selling. Maybe I'm breaking even. They don't know that, but you're still selling, still moving product, you're still providing services, and getting that loan helped, then perhaps it's a good decision. And again, loans can always be repaid. You can always pay them back, pay them off, or refinance down the road at a when the market offers, when the rates go down, the market offers better refinancing conditions.
And pretty much it's always good to have a good credit, because obviously you stand out, better term rates, and more bankable, that you'll be able to obtain the necessary funds. Then I know that Jose spoke briefly based on the different type of loan types: the line of credit, term loans, the leasehold improvements, and the real estate loans. And to obtain the necessary SBA lending for a commercial loan application, you need to have at least 3 years of tax returns, the financial statements, the projections, a business plan. Just in case if you don't know how to develop a business plan, don't worry, we have consultants that can assist you to develop a business plan. And also any plans or specs with the budget, along with the equipment listings. And for the guarantor, anyone owning 20% or more of the company, your personal financial statements, your resume, and also the last 3 years tax returns. Jose, is there anything else that you'd like to include?
Yeah, no, I mean, that's pretty much it. When you're talking a traditional lender, and the SBA, again, handles it through a traditional lending system, you're going to have tax returns on the business, on you personally, financial statements, resume. They're going to pull your credit. Again, if you have accounts receivable, they're going to ask for your accounts receivable aging for the last 90 days. So they're going to want to see, how current are your bills coming in, receivables coming in, or do you have a control of them? They'll look at your current receivables, and then they'll start looking at the 60 days, 90 days. And again, it depends. Some businesses have receivables that are normal to come in at 60 and 90, depending on the product and service you're providing. But again, they'll ask for your receivable inventory, they'll ask for your inventory listing to see your inventory there. So they'll ask for all these documentation. Again, it's also going to depend on the size of the loan and the complexity of the business. Obviously, if you're talking SBA lending, this is a small business that has it's been around for a few years, and they're going to ask for all these items and your bank accounts. Bank accounts can ask for your business bank statements, not your personal, but to ask for your business bank statements. Because that's going to show him, that's going to show them obviously, and it should tie into your financials. If your financials show that you've got, you're selling selling $1 million to a year, you better have $100,000 coming into that account monthly on average. On average, if you don't, then something is not going to jive, and that's going to raise questions. So make sure what you're submitting makes sense. Otherwise, it just starts raising flags with your lender.
Jose, I have a question for you. What about a case of the owner is a non-American citizen? For example, I'm from Chile, currently working with a working visa here in Miami, but I started my business recently and have a lot of questions. How does that affect me being a non-resident?
It has an impact, especially if it's a new business. They're going to ask you, first of all, banks do not necessarily have a problem in lending to foreign nationals. It's all going to depend. It's all going to depend on the business, how long you've been operating that business. From the ownership standpoint, they're going to ask, well, what sort of residency do you have here? If you've got a visa, let's say, and you got a work permit and expires in 2 years, that's a problem, because what's going to happen in 2 years. So it depends on what's your citizenship status here, how long the business has been operating. But just the fact that you're a foreign national, that you're not a U.S. citizen, that itself does not preclude you from financing. It's going to depend on the business. Is this business doing great? What are your accounts like? You may have, you may have tremendous liquidity, and you're just, you're not relocating here could be economic reasons to the U.S. You may have other investments here in the U.S. You may have very strong financial statements with liquidity, cash, investment accounts. Again, I'm giving you scenarios. So it's not just that you're a non-resident alien. That itself is not. There are some loan programs out there, community-based lending programs that you cannot apply for because they only want U.S. citizens. So they're here to help businesses that are core, established, and that there's no foreign component to it. So it depends, but traditional banks, being a non-resident, that does not preclude you from obtaining financing. Again, it's going to go back. It's a factor, and it's going to depend. If you've been in business for 6 months, that's a tough one for a lender. You've been here, you're out for a couple of years, and you've got tax returns, and you've got a strong personal financial statement. Is you relocated here for economic reasons or safety reasons? Excuse me, whatever it may be. It could be explained, and there's long-term commitment here in the U.S. It's going to depend on a few factors.
Thank you, Jose. And then in developing the business plan, we do have a great resource and also a good webinar in regards how to develop a business plan. But this is the overall outline of developing a business plan, which is the executive summary. Save the executive summary as the last part of you writing your business plan, saving the best for last, because this is where it will be able to capture the reader's attention for them to continue to reading your business plan. The personnel, who is part of your team. It could be the accountants, it could be the legal professionals, it could be any other key personnel in your team, the operating procedures, how's the industry, is it growing, is it diminishing, what are some of the current trends, your competition, your competitive analysis, what are your competitors are doing that you're not doing, and how you're able to stand out versus those in the competition who are not doing. That develops your value proposition. Who are your customers, the primary and secondary target markets, what products and services you're offering to the clients in the marketplace, what's your marketing plan, the strategies that you're doing, followed by the sales strategy, the financial breakdowns, and optional appendices. The optional appendices, it could be any articles, any success stories, any cases, any certifications. This is a good opportunity for you to show off and showcase what you're bringing to the table to solidify and present, have a good backing while you're meeting with the lenders. Then the funding request, this is where you have to identify the exact amounts of funding that you need to start your business or have already invested to make sure that it ties specifically with your financial projections. Do not get numbers out of thin air, just have realistic numbers, so that it carries over the funding request and fulfill the requirements within your business plan. Okay, Jose, I have a question for you. Hello, I started a business in November of 23. It is mentioned that it's difficult to have a loan. To contact outside lenders, is a possibility? If yes, which outside lender you recommend? And that would be a good conversation to meet with you, Jose, right? In regards to get to more in depth of the business.
Correct. I mean, it's we're talking. We're already in. Well, we're almost in June, so you've got 6 months. There are some, again, a traditional lender is not going to be for you, because you're not going to have, again, there's always exceptions, but in general, a traditional lender is not going to be for you. There are some outside community-based lenders that may be willing to look at an application based on the 6 months. But again, it's going to depend on other factors. It's going to depend on, they're going to ask for your business bank statements, and what do those show? You know, do those show minimal deposits coming in? That's not going to help. So it has to show that there's deposits coming in. Now there are lenders out there aside from community-based lenders. There's the fintech, the financial technology companies that do lend to companies. You can be a business for 3 months, 4 months, 5 months, but again, they will tie it in to your business bank statements, which they will scrutinize to see. If all of a sudden you open up a business and you've got a great niche and you're selling $20,000 a month, they've got loans for you, you know, because you've got the revenue coming in, so you've got sales, you know, so that's key number one. But if you've got minimal sales and you're just growing and getting off and you don't have any traction yet, you know, the 6 months is immaterial. You don't have the ability to repay a loan. Because remember, these are lenders. These are not grants. These are not these are not COVID charities. These are lenders, and they want to put the money out and they want to get the money repaid. You know, they have some of these lenders may have $1 million, $2 million, $5 million in funds that they receive, could be through corporate donors, through government funding, through different programs, and their sole purpose is to lend it to small businesses in the community. But again, the key word is they're there to lend it. You know, so there is some underwriting. They're not going to give it to a business that's open in some biz that has no sales, because how are they getting? How is that money getting repaid? So they need to be able to see capacity to repay. That is key in any loan discussion. Capacity to repay. So obviously, again, the 6 months is a factor for traditional lending. There's other programs, but it depends what those bank statements show. What's your product? What are you selling? I mean, what industry are you in? So it depends on other factors to tie it in to perhaps a loan. And again, we're talking small business loans. So again, we're not talking large loans here, especially for a new startup. And grants, just on the grant side, grants for startups is extremely difficult. Once in a blue moon, a grant will come out that will make startups eligible. And the grant monies are small. They're small because they open it up to they have limited funds, and they'll open it up to, they want to get more bang for the buck, so they want to lend out small amounts to a lot of startups. But those are rare because they want to help businesses that are struggling or that can make a difference to that business. So these are businesses that usually have been around and are active. So startups are difficult. Startups are difficult in all arenas. Not impossible, but difficult. Just depends on the situation.
Perfect. Okay. And then with the funding request, this is where you're able to discuss, how you intend to use the funds that you receive. Is it more for capital expenditures, working capital, debt retirement, acquisitions? But at the same time, talk about the strategic financial situations, as such, any buy now, being acquired, or selling your business. With the financial projections, this is where you're able to explain your revenue forecast, how much money you have and need, when and how the business expects to make profit. It also details what your marketing, operational procedures, and plans will cost. And most importantly, provide the three financial statements. The three financial statements, it is the projected balance sheet, the cash flow projections, and the profit and loss projections, the P&L. The good thing about the, since we are a federal funded program, the SBA has really good resources and information for you to definitely plug and play of the balance sheets, play around with your projections. So the balance sheets, it reports the company's assets, the liabilities, and the equity. So definitely encourage you to use the link below so that you're able to have a good understanding of your balance sheets of your business. The cash flow projections, it is the money that is coming and leaving of your business over a given period of time. It enables you to meet your existing financial obligations as well as plan for your future. And the profit and loss projections, it breaks down the fixed and variable expenses. The fixed, it is a steady amount that is going to be the expenses on a month-to-month basis. It could be direct or the card payment. While the variable, it could be any commissions, or it could be the your products carried from 1 month to the next. So those are the variable expenses. So each entry on the P&L statement provides the insight into the cash flow of the company. It shows where the money is coming from and how it's being used. And most importantly, when it's all said and done, it is the break-even analysis. It shows a sales threshold that needs to be surpassed before the business becomes profitable. It could be within 1 year, it could be 2 years, but at least you have a good understanding of your break-even analysis. That right there, you're going to be on the black. Jose, do you want to elaborate a little bit more on any of the information?
No, I mean, obviously the breaking out, this refers to recent startups. So obviously, and again, you've got to also have in mind that sometimes the answer is going to be no. Sometimes the answer is going to be you're not bankable at this moment in time. So you're gonna have to continue to bootstrap, get financing from other sources, whether it's friends and family, credit cards, personal loans that are out there, and you may have to go that route until the business has more traction, has a better financial situation that it can reveal to a lender. So it just depends. You have to understand that sometimes the answer is no, and the answer is no because these are lenders, and they've got to be comfortable that the money they're putting out can be repaid. So they've got to be sold on the story.
And then this concludes the webinar. So if you have any questions, strongly encourage you to put them in the Q&A, so that Jose and I will be able to moderate and answer those questions for you. Once again, this is a recorded webinar, so strongly encourage you to like and subscribe our YouTube channel, as we have all of our previously recorded webinars, and also it enhances the conversation with our business consultants. But at the same time, definitely visit our website at bizgop.miami, as we have promoting all of our upcoming events, get to meet with our consultants, and how we can assist you with your business needs. And if you want to meet with one of our business consultants at no cost, feel free to scan the QR code, but also in the chat, you will have the link so you can meet with our business consultants. Once again, it's no cost, and we're more than happy to assist you at any way we can. Okay. Okay, perfect. No, thank you for coming. So from the looks of it, there's no questions. So I want to thank you, Jose, but at the same time, I want to thank all the participants in today's webinar. Anything that we can do to assist you with your business needs, we're an email, a phone call, an event away, as we're family. So thank you all for attending today's webinar, and I'll be looking forward to be working with you soon. Take care, everyone.
Good afternoon,
Thank you,
everybody.
Jose. All right.
Thanks for coming.